Okay, Richard Harris is now joining us. He's Chief Executive at Port Shelter Investment Management. Richard, great to have you with us here. Thank you very much. You know, my first question is with regards to oil prices. Who would have thought, right? With all that is happening, there is positive impulse, isn't there? China is reopening faster than what anyone thought. There is the price cap on Russian oil. One would have thought that would sort of reduce the amount of Russian oil in the markets generally. And yet prices continue to drop. Because, I mean, of course, there is growth slowdown as well. But what's your sense? Are prices going to go down a lot more from here? Or as many are suggesting, you know, this only makes the setup for a bigger rebound more possible? What's your sense?
Well, I think the market has come off for a variety of reasons. The main one is probably the slowdown. And of course, the realization that China has slowed down a lot more, I think, than people actually thought. I'm not so sure the cap will have much effect. And in fact, it may have a detrimental effect. It may actually push prices up. But I do think that maybe we've seen prices come down a little bit fast. And that we're more likely to see a slight recovery from this stage. However, I think we've got to be realistic and say that despite what we're seeing from some of the economics around the world, things are slowing down. People are concerned about inflation. A lot of the negative implications about inflation haven't actually come through yet to the economies. So we're going to be waiting for that till next year.
Richard, hi, good morning. There's a US Fed meeting midweek. If the Fed goes ahead and hikes rates, which in all likelihood it will, and if it's a 50 basis points hike, how do you see equity markets react? And more importantly, markets back home, because that's the viewer that's watching you right now. What should the takeaway be?
Well, I think the thing about interest rates is that the Fed has been consistently wrong all the way through. And that's my concern with looking at the dot plots, you know, the predictions that a lot of the Fed chairmen have that people plot out, is that they've been wrong in the past, so why should they be right now? I think it's very likely that they will increase by half a point. I think they have been surprised maybe at the fact that we have had a fairly strong economy along with fairly strong inflation. Is that a surprise? All the way through. Their announcements that they would maybe slow or maybe even go so far to pivot interest rates, I think, were taken a bit too much by the market. Remember, they're looking at about a slowing going down to 50 basis points from 75 basis points, rather than having a peak in interest rate rises. And as far as I can see, all the indications are that interest rate rises in the US are going to continue. The Fed may be worried about putting it up too fast, which is why they're going to the 50 basis points. But I think we're likely to see 50 basis points being the standard for some more meetings.
All right. Hi, Richard. Good morning. What about the Indian markets? You know, we have been the big outperformers of 2022. The problem is now we're getting a little bit more expensive, and there could be a tactical play on China. Your outlook on the Indian markets from here on, would you allocate more money?
Well, you guys are much more expert than I am about India. I think, obviously, at the moment, China has had a big fallback, and the allocation of emerging market money probably will go more towards China. I think the thing about China is that we haven't really seen the figures that we might have expected from an economy that's been locked down for so long. Remember that we had some substantial falls in GDP growth on a quarterly basis during COVID, during the COVID lockdowns in Europe, in the UK, in the US. We haven't seen those necessarily come through in the figures in China, except for a little bit of a hint that we've had last time round. So I think we have had a very big hit in China, but we will also likely see the kind of recovery that we've seen in other parts of the world when the COVID restrictions come off. It does look as if, should we say, unofficially, officially, the restrictions are starting to come off. And I think that will be positive for China. That'll probably take a little bit of the wind out of the sails from, say, the Indian markets. But I wouldn't necessarily be too concerned, because I think the emerging markets are going to very much mirror what's happening in the developed markets.
Not India, Richard. That's the point, right? I mean, it's just, if 22 has shown that the market here is absolutely Teflon coated. Nothing, you've thrown everything at it, but the market is, it's the best performing large market in the world, right? By far, the Indian market, Richard.
Well, the Indian market's a very fine market. I mean, we sometimes think of it as an emerging market, but it's almost as old as almost any other market in the world. If you take out the UK and maybe the US, it's a significant market with a significant domestic content. Very often it is going to follow its own tune. It's nice to have investors come in as a marginal buyer, but it is going to follow its own tune. And I think that India probably needs to be looked at not as an emerging market, but as a market separate into itself, as you might look at Germany or as you might look at Japan or something like that. Because I sometimes think we forget quite how mature the market is.
The one trade that has played out in India is go short on IT and long on banks. I don't know whether you're following that as much, but do you think that's going to be the trade of 2023 as well?
That sounds like a trade. It doesn't sound like a trend. Obviously, the IT has been affected because it's going to be more impacted by global slowdown. But equally so, if you're looking at a more extended period of global slowdown, a more extended period of inflation, you really kind of have to stick with the companies that are going to lead us out of that. And it's difficult really to see that the banks are anything more than a trade, maybe a 3-month trade or something, but still a trade. But I think if you're looking at an industrial sector, which of course IT is, and it's the darling of the industrial sectors at the moment and has been for, a decade or so, I think you still want to be careful that you're not too underweight in that sector.
All right, Richard, we'll leave it at that. Thanks for a quick take on the market. So the FOMC meeting starts tomorrow and there's a 50 basis points rate hike expected. But Indian markets are something that will continue to be resilient. Let's do one thing. Let's take a quick break. Our list of top 10 stocks is lined up in just minutes from now. Stay tuned.